Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Market5. I'm your co-host, Joel Alconin, along with Brianna Velasquez, and we have Justin Pulitzer on the line. He's a swing trader from New York City. Justin, how you doing today?
Doing okay. Good morning, Joe. How are you guys over there?
We're doing pretty good here, hoping summertime's going to come back. But just wanted to weigh in with you, check in with you here just on the broad market. We've had extended volatility and kind of in a narrow range here. Noticed on the S&P 500 since we hit that 2134 high. We've had seven lower highs. We had one matching high in there at 2275. Just a little pullback, a little consolidation in the market, or do you think a little bit more of a corrections around the corner?
Here's my take on it. The market has been acting fairly predictably for the last 8 months or so. It's been in a consolidation range, and it seems like there are these 100% retracements within a range, and then we've tried to look above the range and then seem to fail back to the middle of the range. So the pattern, if you look on SPY, looks very eerily similarly to the last time. So we would have now just been in that area of the look above, and now we're kind of coming back to mid-range. So my initial thinking is that if you take a look at I usually like to look at the big, like, sort of emotional bar day and use that range to kind of guide me. And in most instances, it's a Fed day. In this instance, it was not. But if you look at the bar from 526, I think if you use that bar as your guide, so anything above 212.91, that's the high of day, is bullish, and anything below 210.20 to me gets a little bit more bearish. And we've spent the last, let's see, 1, 2, 3, 4 days locked inside of that range, very choppy. So I would say it's sort of a go with on anything of a break above and a go with on anything on a break below. A couple of things that have been very key for the market: the 100-day moving average has been a very important level for the bulls, and that comes in around 208.16. So I think if the market does have a little bit of a tumble, it'll probably, if it's going to stay healthy, quote unquote, catch itself at the 100-day moving average, at least for a bounce. If it loses that, then I think we're going to start coming a little bit more deeply into range. And the area that I see as sort of being the max risk here is somewhere between like 205s and 203s, because that was the reference lows from the last range.
Okay, nice breakdown there. I like that term, emotional bar day, and you're looking at the 26 where you had a high at 1250 and a low at 1020. So we'll definitely keep an eye on those parameters in today's trade.
One caveat for your viewers: I know everyone these days seems to like to be technicians, myself included, although some more actual than not. We got into some Fibonacci extensions this go around, so this time, quote unquote, might be a little bit different in the sense that 213.40 was a Fibonacci extension from the 2007 high to the 2009 low, and depending on what time frame you were in, it was between 213 and 214, and we kind of just kissed there. So that might be a little bit more of a significant high than we've seen in the past. So I'm keeping that kind of in context in my head of where, how things might play out. How I've been playing the market and playing this move has been this. I've been playing with smaller size, smaller time frames, and looking for smaller swings. So like if I'm normally looking for $10 over the course of a week, maybe I'm happy to take $3 in the course of a day or two, just because the market is a little bit more erratic, and I'm most comfortable trading in size on either a rising market long or a declining market short, and we aren't in either of those. We're just in a choppy kind of sideways market, so I'm sort of just playing for, I would say, doubles and singles rather than playing, for the home run ball, the long ball.
Excellent discipline there, Justin, and I think that's what we try and stress on this show as much as possible is adapting to the market conditions. And when there's when there's singles and doubles to be hit, you play it there. If there's more home runs, you have to adjust your game plan because if you always have the same style and the same size, like for me, a lot of times when the market's in a tight range and bouncy, sometimes I, get chewed up, to overtrade with the commissions where when you actually do have a move going into the market, it's easier to ride the actual trend. Uh, Fibonacci
I agree
extent.
100. I agree 100%. I think people trade in and out of season, and they don't really realize that in wintertime you don't wear your board shorts, so to speak.
Fibonacci extensions. We talk about Fibonacci numbers 0.382, 0.618. Those numbers, I like the 50% in there. I don't know if Fibonacci actually includes that in there. My buddy Brandon does like to talk about the Fibonacci extensions. Could you just give a quick recap of what they are?
Fibonacci extensions or retracements.
Yes.
So
Yep.
Leonardo Fibonacci was a mathematician. He discovered a number of ratios in nature, and they've been applied to the market, and it's basically percentages of a move. So the Fibonacci on the time frame that I've been discussing, let's say for example in SPY, the low of that move starts at 202.03. And is that the one I'm using? I just want to make it. No, I'm sorry. I'm using 197.87, and the high of that bar is 213.78. So if you, for example, the number you were giving, you like the halfback, the 50%, which is sort of a man-made Fibonacci, but it is. I find it to be very relevant. It does come in around that 205.82. And oddly, remember when we were just discussing where I saw there being risk to, and I said to 205, I said actually between 203 and 205, I was looking at the Fibonacci numbers, and the also where there were some reference lows. The technicals always seem to jive with the fundamentals, in my opinion. Like something will happen there. We'll get there to let's say like 205.82, which is the 50% fib, or the 203.94, which is the 61.8 fib, and something will happen there. Like the Fed will come out and talk, dovishly, or I always find that the news falls along the line of least resistance. Like, for example, this morning we're having some concerns of the terror, right? I believe there are some airplane groundings this morning.
Yeah, they turned out to be hoaxes.
Right, but the news took the market down, and we're still down below the close. I mean, we're not down nearly as much as the overnight low here. I think a lot of people are nervous, and the market has been being kind of I've been calling it a little bit of a hacky sack market here. It's just being kicked around by day traders. You're not really seeing big money coming into the market in any meaningful way because you're not having multiple trend days, and market technicals are being respected like to the tick. Like yesterday, if you look in the market, you had pullback lows and highs to like value area lows and value area highs. For those not initiated, that just means where there had been 70%. The value area is just 70% of the prior day's trade, and then there's mathematical formulas to figure out where the high and the low is based upon the most prominent price, which is known as the point of control. And we were pinging back and forth between those numbers yesterday, like I said, a hacky stack game, a professional hacky stack game. And when I see that, it just tells me that we're in a low confidence market with a lot of sort of short-term volatility by smaller players who are kind of like the speedboats as opposed to the battleships and the aircraft carriers.
Do you have your charts up there? We got a stock coming out of the chat here. We just wanted to see if you had any take on BSFT.
PSFT,
B's and boy, Sam, Frank, Tom. B.
Broadsoft.
Yes.
Uh, Honestly, not a stock I follow. I can give you some opinion on it. I mean, it looks like the stock is. I always like to buy stocks when they're making higher highs and higher lows. The stock seems to be going with that pattern. It had recently had what looked to be a professional gap on their earnings, and then it wound up falling back, and now we're sort of rallying back up, I guess, to those highs. So my opinion would be in the type of market we're in, we're sort of in these cutie pie markets where we have people who recognize levels. If I were trading this, I'm not in the stock, I would be looking to book some profits close to those prior highs, and then I'd be trimming my position and trailing my stop up probably to somewhere between no more than halfway of yesterday's bar.
I have to agree on that. You had the earnings pop, then the drop. Now you're coming back up. I mean, if you really want to get bullish on this thing needs to barrel through that 38.45 high. We got to 38.09 yesterday. I see it's pulling back a little bit, but definitely trimming up near that level, and then also moving the stop up is always good advice. Just
You could
comment.
also if you have profits in the stock, you can also parlay it into. I have to take a like I said, I don't. This is sort of one of the first times I've ever looked at the stock, but you can take a look at some of the options
Yep.
and maybe play it that way. If you want to play with a quote unquote cheaper bet, the implied volatility isn't very high in these options at the moment, and I think you're talking about a 27% IV percentile, so it's not like you're paying up. But sort of the major event took place already with the earnings. It's sort of interesting to me. You mentioned a stock that looks like this, and I could mention to you a few other charts where stocks have had sort of like professional gaps like this, the one that no one is expecting. You can see it sold off multiple days ahead of their print and then gapped up, and then it was sort of like a gap and crap, so to speak. I mean, if you take a look at what happened with Gilead, that could be maybe your boilerplate of this. Although Gilead wasn't at all-time highs like this stock was, when it gapped, it was in range, but it sort of gapped strong on earnings, came back down to fill that, and then it took off. So this looks like it could be one of those examples of a stock that gapped, pulled back, and now maybe is going to do have the move where it really does take off. But I would say if you're sitting in profits in this, I don't know if I would first be initiating chasing here. But you want to see, like you said, you really want to see that 38.45. That kind of has to really be taken.
Okay. Let's. I know you like to follow the big boys, and let's cover a few of those. We only got 8 minutes left, 6, 7 minutes left here with Justin Pulitzer. He's a swing trader, self-directed swing trader. Apple. What do you take? What's your take on Apple?
So my take on Apple is this: is if you're going to play Apple, I believe the premium in there again is too cheap, and it has to be played directionally. And I've been doing it. I've actually been playing it based on this. I believe anything above 129.85, which was the pre-market high of day spike when it was added to the Dow Jones Industrial Average, anything above that area is bullish. Anything below it, to me, is more iffy, quote unquote. So you have a big emotional bar day from 526 again, and that to me is relevant, and it's not the range setting element, but it's an important one. So if you want to look at the 132.91 high or the 129.12 low, I think those could be your kind of guides. The 50-day moving average has been really important in Apple if you've been in the position for a long time. Like, I always think about multiple time frames. So if you're long Apple, you probably want to be long above the 50-day and not so much below. I believe the stock is just going to be in a range for a little while and choppy, although the pattern, if it is to stay true to form, should be a little bit higher. You have the developer conference on the 9th, which is 7 days away. Maybe those Apple options get a little bit of juice into it. I've been playing it long with a call spread. I'm still long the 129, 133 call spread. I had, when I initially put it on, been short 123 puts to help finance it. Those puts got cut in half rather quickly, and rather than kind of rolling the dice with low IV options, I took them off for a profit, but will be looking to put them out again on IV spikes since I didn't 100% pay for my trade. I only paid for about 50 cents or so of it. And now the trade one is about, I think, 80 cents in terms of my total cost of trade.
All right, moving on to Facebook here. The stock is just kind of hanging out here. Had the nice run up after earnings. Give us your take on Facebook.
So Facebook has been really, really choppy. It's one I'm bullish on longer term. I think the stock's going to go to 100. I just don't know that the trajectory it's going to go first. It may need to kind of languish a little bit. I think it's just burning off a lot of the move. I think a lot of these stocks, like the price lines and the Facebooks and the big high flyers, are burning off a lot of their sort of excess move that they had from 2013 and some in 14, and they've just sort of been consolidating. But if you take a look at the pattern of Facebook from the last go round before it had the run up to the all-time high, you had made a high, came down to like a channel low. It's been kind of trading in a channel, and we didn't quite get the channel lows these last couple of times, but I guess we kind of got close enough for government work, so to speak. I think Facebook should resolve itself higher as far as how I see the pattern, but it is really, really choppy. It's really, really been in range. What I've been doing is selling short out of the money puts on dips and using that as a long proxy. And then when the stock rallies up, I take them off and then I sort of rinse and repeat. Some people who aren't comfortable or don't have large enough account sizes to sell puts, they can just do call spreads. I don't like doing weekly calls. I know everyone is really hopped up on weekly calls, but their time decay, theta burn, as it's known, is a little bit too quick in my book. So what I would prefer to see people do in a stock that's range bound is maybe buy longer dated calls and then sell shorter dated weekly calls against it, like buy cheaper, lower IV out of the money calls and then sell, the speedboat, the more expensive ones that decay quicker ahead of them to pay for it, like week after week.
I like the names you have for things. Out of the chat here, we have a couple of our listeners want to see if you have any short trade ideas for today with the S&P's trading down 7 points here. I guess some of our traders are looking to scalp here from the short side. Is there anything that's giving you a potential setup?
Well, if you're looking to play short today, let's just stick to SPY. You want to really see it start making lower lows. You sort of have the gap down, and you're in, like you said, it's usually between 6 or 8 points is usually quote unquote the Goldilocks. So you might want to even play for the fade for the gap fill up. I would think that a couple of spots, if they want to do right or right out types of plays for shorts, would be at the gap fill, if you can get that, or if we can't take out the opening 15-minute range. Like, for example, the high of this rally here I'm just looking in the pre-market session, we saw it was 211.61. If you can't get above like 211.61, 211.56 to 211.61, and there's some type of a bounce, which also coincides roughly with the gap fill, you probably can short there. Or if you have a break down below the first 15-minute bar, like if we're to have a trend day, you could probably use that with the high a day of the bar, since it looks like it's going to be in a narrow range as your stop.
Okay, and do you use average daily ranges for targets? What do you use? Former lows if you're shorting. What do you use for targets?
I would use the value. I've been using the value areas. I also use support and resistance levels if I'm on ES. It just depends on. If I'm doing an individual stock, maybe I'll use like a gap fill or a reference range. I usually use past levels or like levels that
Uh-huh.
I see important numbers.
So
So
when
like for example,
I'm sorry, a gap fill, you're talking about going back up to the close at 11:57.
yeah, we
Okay.
closed
Yeah.
yesterday at what 11? It was at 11:57, right? So if
Yeah.
we got
Okay.
there, you might want to initiate that as a right or right out type of a short if you're looking to short. I mean, not everyone is looking to short. You're already gapping down. I tend to like to fade strength or buy weakness and sell strength. That's sort of what's worked on this tape. So, I think that the market is sort of, if you get a double-digit gap, those are usually harder to fade. They're not the easiest ones to fill right away. But sometime between the 6 and the 8 point gap, those usually tend to fill. If they don't fill, it's telling, and you probably then do want to play a little bit more short. But keep an eye on stocks like Apple. Take a look at the market leaders, see how they're doing. One of the tells, and I think traders have been kind of keying off, is this IWM, and you might want to take a look at the relative strengths or relative weakness of IWM to to SPY and also the QQQ. and then kind of pick off the weakling. You don't want to pick the fight with the big bully in the schoolyard. You want to pick the fight, with the nerdy kid whose lunch money, you can take.
Okay, we've been on the line with Justin Pulitzer. He's a swing trader, born and raised in New York City. Give really detailed analysis on the markets, and for me, it's very easy to follow, especially with the kind of technical trading I do. I really appreciate you coming on, Justin. And, we hope to speak to you again soon.
Hey, no problem. If anyone's interested in me, they can follow me at Twitter. My handle is at Justin Pulitzer.
Okay, great job, Justin. We'll talk to you soon.
All right, buddy. Take it easy.